Molson Coors reported earnings this week. If you follow this channel, you know that I have a position in this company. It's a company that I did a valuation on recently. And so I thought I should come on and give you guys an update about what I thought about the earnings and give you an updated valuation. Welcome to the Stock Sale Flyer. My name is Aaron. None of this is financial advice. Let's go ahead and get into it. As you can see, Molson Coors did not do well after earnings. And this was one where I actually emailed someone and I was happy because when I looked at the earnings results, things looked really good. And then the stock just started to tank. And I said, okay, so what is going on here? This is going to be one of those where, earnings look really good and the company beats. And then, the stock is red. So I had to start looking at what's the reason for this, what's going on. One of the things that happened apparently was they got on the earnings call and they were really cautious about the outlook. I think not just for them, but for the industry as a whole. It says here the company took a more cautious stance in the industry outlook, but they did reaffirm their full year sales and profit forecasts. So from there it was, all right, let's dig into the earnings. Let's take a look at what's going on here. And does my thesis for this stock still hold up? And the answer to that, before I even get into it, is yes, it does. I'm going to highlight a couple of things that I'm keeping an eye on with the stock, but overall, I think this stock is one of the best values in the stock market that I've found recently. That's just my opinion. Again, not financial advice, but I really do believe that. They put out these fancy earnings slides. I circled some things, noted some things from these. I'm also going to bring up some of the financial statements and we'll look at those as well. One of the things overall that I'm really happy with is it seems like the business is focusing on some of its core brands. They did note that retailers are allocating 13 or about 13% more shelf space for Coors Light and Miller Lite in U.S. spring resets. We're coming into a season where they should be doing higher volumes probably for the summer, baseball season. Then in the fall, we'll get football season, we'll get playoff baseball, and then we go into the holiday season. So we should be coming up on some better times for companies like this. And you can see that, I think, reflected in what retailers are doing with their shelf space as we head into those months. You can see here, it looks like they've got some momentum going with some of the Coors brands, including Coors Banquet. So that I see as a positive, again, focusing on those core brands. And then Miller Lite, it looks like they're also showing some growth with this brand. Again, focusing on those core brands, I think that's going to be really key for them as they go forward. And I like to see that. I like to see them focusing on the brands that are not these outliers, these ones that they might try for a little bit and they end up becoming kind of dead weight for the company. Focus on what you do that drives sales, drives revenues, and is successful. Focus on what you do well. That's really something that I like that I'm seeing from the company, is it seems like they're focusing on their core brands quite a bit. You can see the portfolio of what they consider to be core brands. Another thing that seems to be a theme with these beer companies is focusing on products other than beer. And so you're seeing that reflected here when they say strong progress in beyond beer with flavor innovations. This is a focus for Molson Coors going forward, is to make sure that they're keeping up with consumer trends and people who are looking to drink less beer and other types of beverages. So I like that they're trying to stay ahead of this and make sure that they're keeping consumer preferences in mind as they release products. Again, I want to see the focus on the core brands, but I also like that they're adapting and they're trying to make sure that they adjust to market sentiment. Here you can see they released a slide for consolidated first quarter 2024 results. Rather than really focus on this too much and what they wanted to show in the presentation, I think this is a good time to go look at the 10Q financial statements, or at least some of them. So here we have their consolidated results of operations. I apologize if this is a little difficult to read on a smaller screen. So I'm going to just go over some of the things I highlighted here. Net sales were up 10.7% year over year for the quarter. Gross profit up 25% for the same time period. All of these are year over year for this same quarter. Operating income was up 98.7% year over year. Net income was up 186.7% year over year. Net income attributable to Molson Coors Beverage Company per diluted share was up 193.9% year over year. And financial volume in hectoliters was up 5.7% year over year. These numbers, it looked like they crush it. The numbers look really good. I mean, other than the cautious outlook they gave and the guidance that they gave having low sales volume expectations overall, low revenue growth expectations overall, these numbers for the year over year numbers for the quarter look fantastic to me. So I was really happy to see this. And it makes me wonder if they're being cautious just to not overhype the market in case they do see some slowdowns in some ways, or if maybe they're being cautious and it's going to lead to better things, even better things into the future as they continue to execute in the way we saw in this quarter. I mean, I can't guarantee they're going to continue to execute like they did this year over year quarter, but these numbers look really good. Here you can see for the consolidated net sales, 5.7% of the growth was due to financial volume. 4.4% was due to price and sales mix, and 0.6% was due to currency impacts. So I like to see that a lot of this, the majority of this was due to financial volumes. That to me is a good sign. As we go back to the earnings presentation slides, there was some information on this slide that I thought was definitely worth noting. For one, I like that their capital expenditures seemed to be focused on things like efficiency and cost savings. I think that's good. I do like that they reduced their net debt by about $500 million since March 31st, 2023. And the debt is something that I am focused on with this company. So maybe we should go back to the 10Q and take a look at that for a second. So here you have their debt maturity profile, and you can see they have a good amount of debt that's maturing in 2026. This is something I'm keeping an eye on because I'm thinking they're probably going to have to refinance a portion of this debt. I'm hoping that they can pay some more of it down before they have to do that. But it is something worth noting. So I wanted to then go and say, what's the interest rates on this debt and the 2026 debt in particular, if they have to refinance that and interest rates have not come back down to where they were maybe 3-4 years ago, is this something that could potentially be an issue? On the debt obligations page of the 10Q, you can see that $2 billion of notes that are due on July or in July of 2026 have 3% interest rate. So that's a really low interest rate. If they have to refinance that, there's a pretty decent chance. I think they're going to have to refinance some of that at a higher interest rate, which is sort of a drag. But again, it's not something that's going to scare me off from this company because overall, I just think that the stock is priced so cheaply. I think it's a great value right now when you consider everything about the company. That this doesn't scare me away, but I am interested to see by 2026 what happens with this debt. How much are they able to pay down before they have to refinance it potentially? If they do have to refinance it, what kind of interest rate can they get? And to kind of sort some of that out, you can also go and look at what's their credit rating right now. So how are they viewed if they do have to go refinance this debt? So you can see from this page of the 10Q, their current long-term credit ratings are BBB stable outlook with Standard & Poor's. Moody's has them at Baa2 positive outlook, and DBRS has them at BBB stable outlook. So, you know, they're not like a AAA company in terms of their credit rating, but they're viewed as stable. So they should be able to get, you know, decent interest rates if they have to refinance some of that. But whether or not they can get something like 3% again is going to depend on the overall landscape for interest rates between now and when they have to go and refinance that. So it's worth keeping an eye on. One of the things that I did like is that they do have access to up to $2 billion in commercial paper or other borrowings. And this would be at variable interest rates, and they have not drawn on that. So they don't have any borrowings drawn from the potential to do that. So I do think that that's a positive thing when you look at the company's debt structure as a whole, although I am still, you know, more interested in that 2026 debt that's coming due and their other long-term debt. All right, we go back to the earnings release slides. They did pay a quarterly dividend that was up 7% versus the prior year period, and they have been repurchasing stock. I'd actually prefer to see more share repurchases at these levels than dividend increases, but, you know, maybe they'll continue to do both. I don't know what their overall plan is. We'll see. But they are returning capital to shareholders, which I think is a good thing. One of the things I did note from these earnings that I wanted to point out was that they did say there would be a wind down of a contract brewing agreement leading to a reduction of America's financial volume by about 1.6 million hectoliters over the remaining 3 quarters of the year. So I went and looked at the 10K. that they had put out for the year ending December 31st, 2023. And you can see here that they did 83.772 million hectoliters in that fiscal year. So this is not a massive decrease in the amount of volume that they're doing, the amount of financial volume that they're doing, but it does matter, and it is something else that I'm keeping an eye on going forward. In terms of their 2024 guidance, they did reaffirm basically their full year outlook. Net sales revenue growth in constant currency is expected to see low single digits growth, which is not great growth, but my thesis with this company is not that it needs to grow a ton. It's that it's underpriced with these low growth expectations. And so if they see more growth, that's only going to add to the value of the stock. The underlying free cash flow, they're guiding to $1.2 billion plus or minus 10%. And so I took the conservative estimate of that, which was the minus 10%. And I put that into the new valuation that I'm going to give you today. The company did note that their projections were based on some considerations like US brand volume is expected to outpace domestic shipment volume during the remaining 3 quarters of 2024. They noted that underlying costs of goods sold per hectoliter are expected to be higher in full year 2024 as compared to full year 2023. And they said their MG&A expense for full year 2024 is expected to be relatively flat for full year 2023. You look at the presentation, they noted the US volume STRs, which is sales to retailers. So sales to retailers would outpace US sales to wholesalers during the balance of the year. And they note the higher underlying costs of goods per hectoliter also here, and their MG&A being relatively flat. So take that information for what you will. So here's the updated valuation. You can see here revenue growth rate of less than 1% for both this fiscal year and the next fiscal year. And then I did 1% for 2026, 2027, and 2028. So really minimal revenue growth built in for this valuation. The idea with this stock for me is that even with minimal growth, it's already mispriced. It's already cheaper than it should be. Net income margin of 8% is what I went with for each of those 5 fiscal years. So this free cash flow estimate was based on the guidance from the earnings release. They said they would do $1.2 billion plus or minus 10% for free cash flow. So I went with the conservative minus 10% estimate here, and you get $1.08 billion in free cash flow. I then took that free cash flow to net income percentage, and I just carried that forward for the rest of the fiscal years in this 5-year valuation. I've got a 1% perpetual growth rate built into this valuation, which is not very much at all. If they run the business well, they should be able to exceed that. But I went super conservative with this one, and you can see that it still shows that there should be a ton of value on this stock. Shares outstanding, I went with the diluted weighted average shares from the 10Q that they just released. Here are my numbers for the weighted average cost of capital calculation, which is my required rate of return. And you can see I get a fair value of equity of $84.16. You look at the PEs, the prices for different PEs after the 2028 fiscal year. If there was a PE of 10 with this net income assumption, you'd have a price of $45.79 a share. This is again with no change in shares outstanding from the number I used in this valuation. PE of 15, you've got $68.68. PE of 20, $91.57. And PE of 25, you've got $114.47 a share. I think they'll continue to do buybacks, so that should only increase the amount of value that there is on this stock. You can see here the TAP ticker symbol closed May 3rd, 2024 at $57.85 a share. There should be a ton of value built into this one, in my opinion. Thank you for joining me again today, or whenever you're watching this video. Please like, subscribe, and click the bell if you found this video helpful or informative at all. Again, it's not financial advice, but hopefully you got something from it. And also, don't forget to follow me on X at Stock Sale Flyer if you haven't done that yet. I'd love to talk to you over there. I'm always over there posting and talking about markets, so I'd love to see you over there as well. Thank you. Take care.